let me ask you something. Have you noticed how the financial world feels different lately? For years, the advice sounded simple. Put your money in safe assets, hold some bonds, maybe a few mutual funds, stay patient, and eventually, things would work out. But over the past few years, something quietly shifted. Interest rates jumped, markets started behaving strangely, and suddenly, strategies that once felt safe started feeling uncertain. Even large institutions are adjusting how they think about investing. Banks like JP Morgan, EY, and BlackRock release long-term outlooks every year. These reports are hundreds of pages long, full of charts and technical language. Most everyday investors never read them. But hidden inside those reports are clues about where money is moving next. Not guesses, patterns. And if you look closely at the latest outlooks for 2026, three themes keep showing up again and again. Three forces that could quietly shape markets over the next decade. Today, we're going to translate those big institutional ideas into something simple. No jargon, no hype. Just a clearer picture of what might actually be changing. Because once you understand these three themes, a lot of confusing things in the market suddenly start making sense. Theme number one. The AI investment wave is bigger than most people realize. Most people think the AI boom is already hypervalued. After all, AI stocks have been everywhere. News headlines, tech conferences, every conversation about the future. And when something gets that much attention, it usually feels like the opportunity has already passed. But here's the strange part. According to institutional forecasts, we're still in the early chapters, not the final act. JP Morgan and several large research firms believe AI spending could reshape entire industries over the next decade. Not just tech companies, banks, healthcare systems, manufacturing, retail, logistics. Almost every sector is slowly building AI into its operations. But the real story isn't just the companies building AI, it's the infrastructure around it. Think about it for a moment. AI models require enormous computing power, which means more data centers, more semiconductor demand, more cloud infrastructure, more energy consumption. In fact, some analysts now believe AI data centers could become one of the largest drivers of electricity demand in the next decade. That's a massive ripple effect. And this is where institutional investors are thinking differently than most individuals. Retail investors often chase the headline company, the one everyone talks about. But big funds often focus on the ecosystem around the trend, the suppliers, the infrastructure, the quieter companies that power the system. It's similar to what happened during the internet boom. In the late 1990s, most people focused on flashy dot-com startups. But the real long-term winners were often the companies building the underlying infrastructure, semiconductors, networking equipment, cloud systems. And today, the AI build-out looks surprisingly similar, which means the opportunity isn't just AI companies, it's the industries quietly supporting the AI economy. And that leads to a subtle shift in how many institutional portfolios are being built. Instead of chasing hype cycles, they're diversifying across the broader ecosystem. Because when a technological wave this large begins, it rarely lifts just one sector. It reshapes entire supply chains. Theme number two. The world is becoming more economically fragmented. For decades, globalization followed a simple pattern. Countries specialized in what they did best. Manufacturing moved to the lowest cost locations. Supply chains stretched across continents. Products were built in pieces, traveling through multiple countries before reaching consumers. And for a long time, that system worked incredibly well. It kept prices low, it boosted efficiency, and it helped companies grow quickly. But recently, that model has started to change. Events like geopolitical tensions, trade disputes, and supply chain disruptions have pushed governments to rethink how dependent they are on other regions. You've probably seen small examples of this already. Semiconductor manufacturing moving closer to the United States, European countries investing in domestic energy, governments encouraging companies to build supply chains closer to home. Economists call this economic fragmentation. Instead of one fully globalized system, the world may gradually shift towards several regional economic blocs: North America, Europe, Asia, each one becoming a little more self-reliant. This doesn't mean global trade disappears, but it does mean supply chains could become shorter, more regional, and sometimes more expensive. And that shift has huge implications for investors, because when supply chains change, entire industries must rebuild infrastructure, factories, transportation networks, energy systems, technology production. All of it requires investment. In fact, some analysts now believe this restructuring could drive trillions of dollars in capital spending over the next decade. And that creates opportunities in sectors many investors rarely think about: industrial manufacturing, infrastructure companies, energy producers, logistics providers, the kinds of businesses that rarely trend on social media but quietly power the real economy. For many years, these sectors were considered slow and unexciting, but when global systems start rebuilding themselves, those industries suddenly become very important again, which is why institutional investors are paying close attention. Not because fragmentation is exciting, but because big structural changes often create long investment cycles, and those cycles can last much longer than market headlines suggest. Theme number 3: the return of inflation risk. For a long time, inflation felt like something from the past. In the 2010s, central banks around the world struggled to push inflation higher. Interest rates stayed extremely low, and many investors built portfolios assuming that environment would continue. Bonds were considered one of the safest parts of a portfolio. They offered stability, predictable income, and protection during stock market downturns. But the inflation surge after 2020 changed how many economists think about the future. Even though inflation has cooled from its peak, many institutions now believe we may be entering a different long-term environment. Not runaway inflation, but a world where inflation remains more persistent than it was in the previous decade. There are several reasons for this: aging populations in many countries, rising government spending, energy transitions, and the supply chain restructuring we just discussed. All of these forces can gradually push costs higher, which brings us to an interesting shift in how investors think about bonds. For decades, bonds were viewed as the safe side of a portfolio.
But when inflation rises, bonds can lose purchasing power. And when interest rates climb quickly, bond prices can fall. We saw that happen in a dramatic way during 2022, when global bond markets experienced one of their worst years in history. For many investors, it was a wake-up call. Assets that once felt predictable suddenly became volatile. And that's one reason some institutional investors are rethinking the traditional 60-40 portfolio model. Instead of relying heavily on bonds for stability, they are exploring broader diversification, including assets like infrastructure investments, commodity exposure, real estate, and diversified mutual funds or ETFs that spread risk across multiple sectors. Which brings us to something that may surprise many people. In this changing environment, diversified funds may actually become more important, not less. Because when markets become more uncertain, diversification becomes more valuable. Why mutual funds and diversified ETFs are quietly making a comeback. There was a period when individual stock picking became extremely popular. Social media amplified the biggest winners. Tech stocks dominated headlines, and many people felt confident choosing a handful of companies to build their portfolios. But institutional investors often think differently. Their goal usually isn't finding the one stock that explodes upward. Their goal is building systems that survive many different market conditions: inflation, recessions, boom cycles, geopolitical changes. Because no one can predict exactly which environment will appear next. And this is where diversified funds start to make more sense. Instead of betting on one outcome, they spread exposure across many industries and regions. That doesn't mean they always outperform individual stocks, but they often reduce the risk of being completely wrong, which matters more than many people realize. Because long-term investing isn't just about maximizing gains, it's also about avoiding catastrophic losses. And when you look at institutional portfolios, diversification is almost always at the center, not because it's exciting, but because it's resilient. The bigger shift most investors haven't noticed yet. When you step back and look at these three themes together, something interesting appears. AI expansion, global economic fragmentation, persistent inflation risk. They might seem like separate stories, but they're actually connected. AI drives massive infrastructure spending. Supply chain shifts drive regional manufacturing growth. Inflation pressures push investors toward real assets and diversification. Together, these forces are reshaping how capital flows through the global economy. And that's why institutions are adjusting their strategies now, not reacting to headlines, preparing for structural changes that could last for years. What this means for the average investor. Hearing about institutional outlooks can sometimes feel intimidating. Huge banks, massive research teams, complex forecasts. But the real takeaway isn't about copying their portfolios. It's about understanding the bigger patterns they're watching. Technology waves, economic restructuring, inflation dynamics. These are slow-moving forces. They unfold over years, sometimes decades, which means individual investors often have more time than they think. Because the biggest opportunities rarely appear overnight. They build gradually as new systems take shape. A simple way to think about the next few years. Instead of asking, what stock will explode next, a more useful question might be, what long-term forces are shaping the economy? Because when you follow those forces, investment decisions often become clearer. You stop chasing noise and start noticing patterns. Patterns like the ones large institutions are studying right now. The AI infrastructure wave, the restructuring of global supply chains, and the return of inflation as a long-term economic factor. None of these themes guarantee specific outcomes, but they help explain why markets are evolving the way they are. The quiet advantage individual investors still have. Ironically, individual investors still hold one powerful advantage over large institutions: time flexibility. Massive funds often manage billions or trillions of dollars. That size limits how quickly they can move. Smaller investors don't have that constraint. They can adapt faster, invest smaller amounts across different opportunities, and gradually build positions over time. But that advantage only works when decisions are guided by understanding, not emotion, which is why learning the bigger economic stories matters, not to predict the future perfectly, but to recognize when the world is quietly changing. Every generation of investors faces a moment when the old rules start shifting. For many years, the investment world was shaped by ultra-low interest rates, stable globalization, and relatively quiet inflation. But the next decade may look different. Artificial intelligence expanding across industries, global supply chains reorganizing, inflation remaining a persistent force. Three themes that might quietly influence markets far more than daily headlines. And while no one knows exactly how it all unfolds, understanding the direction of these changes might be one of the most valuable things an investor can do. Because sometimes the biggest opportunities aren't hidden in complicated strategies. They're hidden in the slow, structural shifts happening right in front of us. And once you see them, you start looking at the market very differently.